Mambo vipi forex traders? Karibuni tena kwenye channel. Na leo nataka niwaambie kwamba moja kati ya kitu kikubwa na cha msingi sana kwenye biashara ya forex ni saikolojia ya trading. Umeona? Trading psychology. Na ukitaka kufanikiwa sana kwenye hili swala, unatakiwa uwasikilize forex traders wa miaka ya nyuma sana. Matrader wazee, wakongwe, wale ambao walitrade miaka ya nyuma, wakaandika vitabu na kuacha historia mbalimbali zinazohusiana na mambo ya saikolojia ya kutrade. Leo nakuletea audiobook ya kitabu cha Trading in the Zone. Hichi kitabu kiliandikwa na trader mmoja alikuwa anaitwa Mark Douglas. Ni marehemu, ameshafariki huyu bwana. Lakini ni kitabu ambacho kinazungumzia jinsi ya kumaster masoko kwa kuwa na confidence. Umeona, pamoja na kuwa na discipline, umeona, pamoja na kuongeza tabia ya kushinda sokoni. Umeona, tabia ya kushinda mara kwa mara sokoni. Huwezi kushinda mara zote, lakini ile winning attitude, kwamba unakuwa una utaratibu wa kushinda mara kwa mara unapoingia sokoni. Sasa sikiliza hichi kitabu, takriban masaa mawili. Umeona, make sure unasikiliza, kwa sababu najua sisi wabongo wengi ni wazito kusoma vitabu. Ndio maana nimefanya ninachofanya, nimehakikisha nakuletea hii audiobook ili uweze kuisikiliza. Umeona, na kwa kutulia hayo masaa mawili kwa kusikiliza hichi kitabu kitakusaidia wewe kuweza kuwa na uwezo wa kuielewa saikolojia ya kutrade, na hivyo itaongeza uwezo wako wa kushinda mara nyingi sana unapokuwa unaingia sokoni. Kwa hiyo make sure una pay attention na una tune na unasikiliza hichi kitabu cha Trading in the Zone.
Welcome back, traders. If you're looking to level up your trading game, then you're in the right place. In today's video, we're diving deep into the powerful book Trading in the Zone by Mark Douglas, a must-read for anyone serious about trading. But before we jump in, don't forget to like, share, and subscribe to the channel so you never miss out on content that can help you improve your trading skills. Now, let's talk about what this book is all about. Mark Douglas, one of the foremost experts in trading psychology, helps traders like you and me break free from common mental barriers and emotional pitfalls that stop us from making consistent profits. This book isn't about charts, technical indicators, or price patterns. It's about mastering the mental game that determines your success in the market. In Trading in the Zone, Douglas takes us on a journey through the world of trading psychology. He teaches us how to think like a professional trader, how to embrace uncertainty, and most importantly, how to manage our emotions so we can make better, more calculated decisions. Throughout this book, we cover key topics like the mental dynamics of success, what's holding you back from achieving consistency in trading, how to manage your emotions, overcome fear, greed, and doubt that cloud your judgment, the importance of discipline and trust in your trading system, building self-confidence and creating a belief system that supports success, and much more. By the end of this book, you'll have a roadmap for not just surviving, but thriving in the markets with a strong, disciplined mindset. If you're ready to get started, then keep watching, and let's dive into the world of Trading in the Zone. All right, traders, let's kick off Trading in the Zone by Mark Douglas with Chapter 1, The Road to Success. If you've ever believed that technical or fundamental analysis alone is the key to making money in the markets, this chapter is going to shake that belief to the core. The harsh reality of market analysis. Most traders think that if they master chart patterns, indicators, or financial reports, they'll have an unstoppable edge. But let's be real. How many times have you followed a perfect setup only to watch the market go completely against you? That's because market analysis alone will never guarantee success. Mark Douglas makes it clear, the market is unpredictable. Even with the best analysis, you can't control the outcome of any single trade. Why? Because every moment in the market is unique. The same pattern that worked yesterday might fail today. And here's the kicker. Even if you have an edge, your mindset will determine whether you actually profit from it. The trap most traders fall into. Douglas exposes a dangerous cycle that many traders get stuck in. 1. They search for the perfect strategy. They test indicators, tweak settings, and follow expert predictions. 2. They win a few trades. Confidence skyrockets. They think they've figured it out. 3. They hit a losing streak. Doubt creeps in. They question their strategy. 4. They switch methods, looking for the next holy grail. 5. Repeat the cycle. over and over again. Sound familiar? That's because most traders focus on the wrong thing, trying to predict the market instead of mastering their own psychology. Why trading psychology is the real key. Douglas isn't saying that technical or fundamental analysis is useless, but even with the best strategy in the world, your mindset will make or break you. If you fear losing, you'll hesitate on good trades. If you get overconfident, you'll take reckless risks. If you need to be right, you'll hold on to losers too long. If you lack trust, you'll constantly change strategies. See what's happening? Your emotions dictate your decisions, and if you can't control them, the market will control you. How to break free and trade like a pro. So, what's the solution? Douglas says you need to rewire your mindset and trade with a probability-based approach. Accept that anything can happen. No single trade matters. Follow your system without fear or hesitation. Trust the process. Detach from individual wins and losses. Focus on long-term results. Train yourself to think in probabilities, not predictions, because at the end of the day, it's not the market that decides your success, it's you. And that, traders, is where the real journey to trading in the zone begins. The lure of trading. Why do it? If you've ever wondered why trading is so addictive yet so brutally challenging, this chapter explains it all. Why are we drawn to trading? Let's be honest, most people don't get into trading just to invest for the long term. They enter the markets for something much bigger, freedom. The idea of making money on your own terms, no boss, no 9 to 5. Unlimited income potential. Unlike a job, there's no salary cap. You can make as much as the market allows. Thrill and excitement. The rush of making a successful trade. The adrenaline of watching price movements. Control over financial future. The ability to create wealth without relying on anyone else. But here's the problem. What draws people into trading is also what destroys them. The hidden challenges of trading. Douglas reveals something most beginners don't realize. Trading is the ultimate psychological challenge. Unlike a regular job where effort equals reward, trading operates in a world of uncertainty. You can work hard, analyze every detail, and still lose money, and that messes with people's emotions big time. Here's why trading is so difficult. 1. There's no structure. In a job, you have clear tasks. In trading, there are no rules, just you and your decisions. 2. There's no guaranteed paycheck. You could go weeks without making money, or worse, losing money. 3. The market doesn't care about you. It won't reward you for effort, time, or how badly you need to win. 4. Your biggest enemy is yourself. Fear, greed, hesitation, and overconfidence will sabotage you if you let them. This is why most traders fail, not because of bad strategies, but because they never learn to control their emotions. The dangerous illusion of trading. Most new traders start with a dangerous mindset. They think, I'll just follow this strategy and make money easily. Once I master technical analysis, I'll win most of my trades. I can turn $1,000 into $100,000 in a few months. But here's the truth. Trading is not a game of knowing. It's a game of execution. And most people can't handle the mental pressure that comes with real money on the line. Douglas explains that trading tricks your brain in ways no other profession does. It gives you the illusion of control, but you actually have zero control over market movements. It makes you believe in certainty, but every trade is just a probability game. It feeds your ego, making you want to be right instead of being profitable. The harsh truth. Trading is a psychological war. Trading is not about mastering the markets. It's about mastering yourself. Can you handle losing without fear? Can you take profits without greed? Can you stick to your plan when emotions tell you to do the opposite? If you can't, the market will eat you alive. That's why Douglas stresses, success in trading is 80% psychology and only 20% strategy. The key takeaway. Most people get into trading for money, freedom, and excitement. But very few survive because they never learn to manage their emotions. So ask yourself, are you ready to treat trading like a business? Or are you just here for the thrill? Because if you can't control your mind, you'll never control your trading. The trader's edge, thinking in probabilities. All right, traders, let's dive into Chapter 3 of Trading in the Zone, where Mark Douglas drops one of the most powerful concepts you'll ever learn about trading: thinking in probabilities. Now, I know what you're thinking. What does thinking in probabilities mean? Well, buckle up, because this chapter is about to completely shift your mindset. The truth about certainty in trading. Here's the big idea. There is no such thing as certainty in trading. No matter how much research you do, no matter how many indicators you stack, or how much you study charts, you can never be 100% sure about the outcome of any trade. The market doesn't guarantee success. The moment you believe you know what's going to happen next, you're setting yourself up for disappointment. Why? Because trading is a game of probabilities, not certainties. So, what does that mean for you as a trader? Why thinking in probabilities is your edge. Douglas emphasizes that successful traders don't focus on predicting the exact future of the market. Instead, they accept uncertainty and think in probabilities. Let me break it down for you. A trade is essentially a probability event. When you enter a trade, you're not betting on the outcome. You're betting on the likelihood of a certain outcome based on your system or strategy. Maybe you have a 60% probability of success. Maybe your strategy has a 70% edge over random price movement. But the key is, no outcome is guaranteed. And once you accept this, trading stops feeling like a battle to be right and starts feeling like a game of probabilities, where you let your edge play out over time. The problem with needing certainty. A lot of traders struggle with the need to be right on every single trade. It's human nature. We don't like to be wrong. But in the world of trading, this is where most traders fail. They get emotionally attached to being right about every trade. When they win, they feel on top of the world. When they lose, they're devastated. But what if you stop trying to be right all the time? What if you embrace the idea of losing trades as part of the game? Douglas says, if you have an edge, it doesn't matter if you're wrong on a trade. Over time, that edge will play out. How to apply probabilities to your trading. Here's how you can actually start thinking in probabilities. 1. Forget about winning every trade. Instead, focus on your long-term edge. In other words, be consistent, and over a large sample of trades, you will start seeing profits. 2. Make decisions based on logic, not emotion. When you're thinking in probabilities, you can separate emotion from the outcome. If you trust your system, losing a trade doesn't feel personal. It's just part of the process. 3. Focus on the process, not the outcome. The more you stick to your system, the more you let the probabilities work in your favor. Stop obsessing over individual trades and trust the law of large numbers. Your edge will show up over time. 4. Use proper risk management. Even with the best system, losses are inevitable. So manage your risk carefully. Never bet too much on one trade, because you don't know what's going to happen next. The takeaway. Control the process, not the outcome. Douglas's key message here is powerful. You cannot control what happens in the market, but you can control your process. When you start thinking in probabilities, you remove the emotional burden of every single win or loss. You understand that you don't need to be right every time. You just need to have an edge and let the probabilities play out over time. So ask yourself, are you focusing on being right, or are you focusing on executing your system and letting the probabilities work in your favor? Because at the end of the day, the trader's edge comes from thinking in probabilities, not in certainties. The dynamics of perception. What creates the mental environment for trading? Let's talk about something absolutely crucial in your journey to becoming a successful trader. Perception. Mark Douglas digs deep into how you see the market and how your beliefs shape every single decision you make in trading. How your mind shapes your trading decisions. Here's the reality check. The market doesn't make decisions for you. It's your mindset and how you perceive the market that creates your results. And guess what? Most traders aren't even aware of how their beliefs shape their trades. You see, the way you interpret market information is never neutral. Every chart, every price move, every news event, you don't just observe these things objectively. You interpret them through a lens built on your beliefs, past experiences, fears, and emotions. And this is where most traders go wrong. The role of beliefs in shaping perception. Douglas makes it clear that your beliefs, whether you realize it or not, are programming your mind and ultimately your actions. If you believe that the market is out to get you, guess what? Your trades will reflect that. You'll feel fear, hesitate, or overcompensate in risky positions. But if you believe that the market is neutral or that it's just probabilities at play, then you'll approach each trade with a clearer, more objective mindset. You'll stop fighting the market and start working with it. Here's the kicker. Most traders don't question their beliefs. They act as if they're absolutely true. But in reality, those beliefs can either be empowering or self-destructive. The perception of risk. One of the key elements that shape how you trade is how you perceive risk. If you see risk as something negative, something to avoid at all costs, you'll be paralyzed by fear. If you see risk as an inevitable part of the game, something you can manage and calculate, you'll approach it with a calmer, more disciplined mindset. Douglas talks about how some traders are so afraid of losing that they can't make a move. They hold on to losing positions, hoping they'll bounce back because they're afraid of admitting they were wrong. That's a belief problem. They're perceiving the market as an enemy, and that's why they're not accepting reality. On the other hand, a trader who has accepted that losing is part of the game and that it's only through managing risk and executing their plan that they will succeed long term, will approach risk with a completely different mindset. How perception affects every trade. Here's a crazy truth. Every trade you make is colored by your perception of the market. If you believe a certain pattern is bulletproof, you'll be too eager to enter that trade, and when it fails, you'll be emotionally devastated. If you're constantly looking for certainty, you'll hesitate to take action because uncertainty is uncomfortable. But here's what the successful traders know. The market doesn't care about your beliefs. The market doesn't care if you think a stock is going to the moon or if you're terrified that it'll crash. It just moves based on supply and demand, and your ability to adapt to those movements will determine your success. The power of awareness and control. Douglas stresses the importance of awareness in trading. The more you're aware of your own beliefs and perceptions, the more you can start changing them. You don't have to believe everything your mind tells you, especially when it comes to trading. For example, when fear strikes, instead of letting it take over, you can pause, take a step back, and question the reality you're seeing. Is the market really that dangerous, or is it just your belief system making you feel that way? The takeaway: shift your perception, shift your trading. Here's the key takeaway from Chapter 4. Your perception creates your reality in trading. If you can change how you see the market, you can change how you react to it. Challenge your beliefs. Are they serving you, or are they limiting you? Question your fears. Are they based on facts or emotional biases? Learn to accept uncertainty. The market is unpredictable, and that's okay. By shifting your perception of the market, you'll stop seeing it as something to fear or control. Instead, you'll start seeing it for what it is, a series of probabilities, and approach it with the clarity and confidence that successful traders have. So, traders, ask yourself, what beliefs do I have about the market that might be holding me back? Because once you change your perception, your whole trading game will shift. The trader's edge, the mental dynamics of price movement. All right, traders, it's time to talk about price movement, the lifeblood of every trade. Mark Douglas breaks down the mental dynamics behind price movement and how your mindset needs to be in sync with the market for success. This chapter is huge because understanding price movement isn't just about charts and indicators. It's about how you perceive and respond to those movements. The market doesn't move in straight lines. Here's the first reality check. Price doesn't move in straight lines. So many traders get caught up in this idea that prices should follow a perfect, predictable trend. They expect the market to move according to their analysis, and when it doesn't, they get frustrated, emotional, and start second-guessing their decisions. But the truth is, price moves in waves, and uncertainty is a part of the process. There will always be moments when prices pull back or go sideways before they break out again. Understanding this dynamic is crucial to your success. Price movement, a psychological game. Douglas emphasizes that price movement is as much psychological as it is technical. It's driven by human emotions, fear, greed, uncertainty, excitement, all of which affect the decisions of traders in real time. For example, when the market starts going in your favor, you're riding high on excitement. But as soon as there's a slight pullback, fear kicks in and you panic. Or when the market is trending strongly, traders get greedy and start thinking it will continue forever, leading them to overtrade. This back and forth emotional ride creates market fluctuations, those sudden spikes and dips you see on the chart. And here's the kicker. These price movements aren't random. They reflect the collective psychology of the market. Aligning your mindset with price behavior. So how do you align your mindset with the market's behavior? The key is to stop fighting the market and start working with it. You see, when you start understanding that price movement is driven by emotions, you can predict how the market will react in certain situations. This is when your mindset shifts from reactionary to strategic. Here's how to align yourself. 1. Stop trying to predict every move. You can never know exactly where the price is going next, and that's okay. Focus on probabilities and work with the market's flow. 2. Accept volatility. Instead of fearing price swings, embrace them. Volatility is a sign of market opportunity, and it's where your edge lies. 3. Trade with the market, not against it. If the market is in an uptrend, don't fight it. If it's choppy and indecisive, don't try to force trades. Let the market's behavior guide you. 4. Stay calm under pressure. It's easy to panic when price moves against you. But when you understand that price moves in waves, you'll see pullbacks as just temporary fluctuations, not permanent losses. The role of risk and reward. Douglas also talks about the importance of risk and reward in understanding price movement. If you're always thinking in terms of high reward, you might get greedy and risk too much. If you're too focused on avoiding losses, you might miss out on profitable moves. It's all about finding a balance. When you align your mindset with how the market moves, accepting that price will fluctuate, sometimes unpredictably, you'll start making smarter, more calculated decisions. Understanding price movement leads to consistency. Here's the key takeaway. When you understand the mental dynamics behind price movement, you stop getting caught in emotional swings. You stop fearing the pullbacks. You see them as opportunities. You stop chasing after every spike. You wait for the market to come to you. You stop trying to predict everything. You focus on managing risk and letting your edge play out over time. When your mindset is in harmony with the way the market moves, you'll see more consistent results. The more you understand the mental dynamics behind it, the more you understand your own psychology, the more you can align your trades with the market's natural flow. So the next time the market starts moving, don't react out of fear or greed. Instead, step back, analyze the movement, and align your mindset with the behavior of the market. Let the market teach you how to move, rather than trying to control it. That's the secret to turning your trading into a consistent, profitable journey. The trader's edge, the dynamics of goal achievement. Mark Douglas breaks down the concept of setting realistic goals and overcoming the psychological barriers that often stand in your way. If you're struggling to make consistent progress, this chapter is critical. Setting realistic trading goals. The first thing Douglas emphasizes is the importance of realistic goal setting. When you start trading, it's easy to get caught up in lofty ambitions, dreaming of big profits, huge returns, and instant success. But here's the reality. Trading is a marathon, not a sprint. If you set goals that are too far out of reach, you're setting yourself up for frustration and disappointment. Instead, you need to break down your goals into small, achievable steps. Start with realistic expectations and gradually work your way up. This helps you build the discipline and patience you need to succeed in the long run. The psychological barriers to achieving goals. Douglas also sheds light on the psychological barriers that prevent traders from achieving their goals. Fear, greed, and doubt are the primary emotions that get in the way. Let's break down how these emotions affect your ability to reach your trading goals. 1. Fear. Fear of loss or making a mistake often leads traders to hesitate, causing them to miss opportunities. If you're afraid to take a loss, you'll often hold on to losing trades, hoping they'll recover, which only magnifies the problem. 2. Greed. On the flip side, greed can push you to take unnecessary risks in pursuit of higher profits. This leads to impulsive decisions, such as over-leveraging or entering trades without proper analysis. 3. Doubt. Self-doubt is a killer in trading. If you constantly question whether your system is working, or if you're second-guessing your decisions, you're not allowing yourself to fully commit to your trading plan. All these psychological barriers can lead to emotional trading, where decisions are based on feelings rather than logic and strategy. This is a surefire way to derail your progress and prevent you from achieving your goals. How to overcome these barriers? So, how do you get past these emotional blocks and achieve your goals? It starts with mindset. 1. Shift from fear to confidence. Trust your trading plan and strategy. If you've done the work, there's no need to fear losses. Every loss is part of the game, just a learning opportunity. When you make decisions based on confidence, fear takes a back seat. 2. Replace greed with patience. Rather than chasing after quick profits, focus on long-term consistency. Your goal isn't to hit home runs on every trade, but to make steady, reliable progress. Patience is key here. Let your system work for you. 3. Build self-belief. Doubt kills consistency. Instead, focus on developing a strong belief in your strategy and system. Trust the process and remember, success doesn't happen overnight. It's the accumulation of consistent, well-executed trades. The importance of a plan. Douglas stresses the importance of having a clear trading plan that aligns with your goals. Without a plan, it's like driving without a map. You have no idea where you're going, and you're bound to get lost. Your trading plan should outline what type of trades you'll take, your risk tolerance, your entry and exit strategies, how you'll measure success. When you follow a plan, it minimizes emotional decision-making and keeps you focused on the process rather than the outcome. A solid plan helps you stay on track and achieve your goals without being swayed by short-term emotions. The takeaway: focus on progress, not perfection. The bottom line of this chapter is that goal achievement is about progress, not perfection. Here's what you need to focus on. Set small, realistic goals and build from there. Overcome the psychological barriers, fear, greed, and doubt that cloud your judgment and decision-making. Stick to your trading plan, trust the process, and stay patient. Lastly, remember, every loss is just part of the learning curve. Your ultimate goal should be consistency, not perfect trades. When you get your mindset aligned with these principles, you'll start seeing real progress in your trading journey. Achieving your goals isn't about hitting home runs every time. It's about staying disciplined, being patient, and letting the small wins build over time. That's where true success lies. The dynamics of creating a belief system. All right, traders, it's time to talk about something that might be the most important factor in your trading success: your belief system. In Chapter 7 of Trading in the Zone, Mark Douglas explores how you can create a belief system that empowers you to make the right decisions and stay disciplined in the face of uncertainty. Without a solid belief system, you're just drifting in the market, reacting to whatever comes your way. But with the right beliefs, you can turn the market into your ally instead of your enemy. Beliefs shape everything you do in life. And trading is no different. Your beliefs influence how you see the market, how you react to losses and gains, and how you perceive your ability to succeed. In fact, your mental framework determines whether you make consistent profits or get stuck in a cycle of emotional trading and losses. So, what's the key to developing an empowering belief system? It starts with understanding that beliefs are not facts. They're simply the stories you tell yourself about the world around you. The good news is, you can change your beliefs anytime. Limiting beliefs versus empowering beliefs. Douglas breaks down the difference between limiting beliefs and empowering beliefs. 1. Limiting beliefs. These are the thoughts that hold you back. They might sound like, "I'll never be a successful trader," or "the market is rigged against me." These beliefs make you react negatively to losses, feel helpless, and doubt your abilities. 2. Empowering beliefs. On the flip side, empowering beliefs are those that support your growth and success. Every loss is a learning opportunity. Or, I trust my strategy and follow it with discipline. These beliefs give you the mental strength to persevere through tough times and stay focused on the bigger picture. How beliefs affect your trading. Now let's talk about how your beliefs affect your trading decisions. If you believe that the market is unpredictable and that you'll always lose, you'll approach trading with fear and doubt. You might second-guess your decisions, avoid taking trades, or exit too soon out of panic. In this case, your beliefs are creating a self-fulfilling prophecy. Because you're operating from a place of fear and uncertainty, you're more likely to make poor decisions and lose money. On the other hand, when you believe that you can develop a solid strategy, manage risk, and stay disciplined, you begin to act with confidence and clarity. Your belief system gives you the emotional stability to ride out the highs and lows of the market without getting thrown off track. How to develop empowering beliefs. So, how do you develop these empowering beliefs? It's a process that requires self-awareness, consistency, and time. Here's how you can start. 1. Identify your current beliefs. First, take a moment and ask yourself, what do I really believe about trading? Are your beliefs helping you succeed, or are they holding you back? Write them down. 2. Challenge your limiting beliefs. Once you identify limiting beliefs, challenge them. Ask yourself, is this belief really true? Is it serving me? What evidence do I have that this belief is incorrect? For example, if you believe the market is unpredictable and you'll never succeed, ask yourself, are there successful traders who have mastered the market? What are they doing differently? 3. Replace with empowering beliefs. Now that you've identified your limiting beliefs and challenged them, it's time to replace them with empowering ones. Instead of thinking, I'll never be good enough, try thinking, I'm constantly improving and learning from my mistakes. 4. Reinforce your empowering beliefs. Just like any habit, your new empowering beliefs need to be reinforced. Daily affirmations, visualization, and positive self-talk are powerful tools to rewire your mindset. Every time you face a challenge, remind yourself that you have the ability to overcome it. The more you repeat this, the more your new beliefs will stick. Belief and risk management. One of the most significant aspects of trading is risk management, and your beliefs play a huge role in how you handle it. If you have a fear-based belief system, you might be too cautious and avoid taking calculated risks, missing out on potential opportunities. Or you might over-leverage yourself, taking risks that don't align with your risk tolerance, driven by greed or overconfidence. But when you adopt empowering beliefs, you begin to see risk management as a way to protect your capital and ensure long-term success, rather than something to fear. You understand that accepting risk is an integral part of the process and that you can control it through a disciplined approach. Trusting yourself and the process. Finally, it all comes down to trusting yourself and trusting the process. Empowering beliefs help you stay patient, disciplined, and focused on the long term. When you trust that every trade is part of a bigger journey and that you'll learn and grow from every experience, you become much more resilient when things don't go as planned. The takeaway: build a belief system that supports success. So, the takeaway here is simple. Your belief system is the foundation of your trading success. If your beliefs are aligned with empowerment, confidence, and growth, you're going to make better decisions and handle the inevitable ups and downs of trading with grace. It's time to shift your mindset, challenge the beliefs that are holding you back, and reinforce empowering beliefs that support your success. Because at the end of the day, it's not about the strategy or the system. It's about how you think and believe in yourself. So, what beliefs are you going to choose today to take your trading to the next level? The dynamics of thinking like a trader. Mark Douglas helps you unlock the mental shift you need to start thinking like a professional trader. Because here's the hard truth. Trading isn't just about knowing charts or technical indicators. It's about mentally mastering the game. In this chapter, Douglas breaks down exactly what kind of mindset you need to thrive in the unpredictable world of trading. Let's dive into it. The importance of thinking like a trader. The key takeaway from this chapter is mental shift. To be a successful trader, you have to let go of the traditional ways of thinking and fully embrace the mindset of a professional trader. What does that mean? It means thinking beyond the basic strategies, letting go of ego, and fully understanding that you're not here to predict the market, but rather to respond to it with skill, patience, and control. A professional trader doesn't just rely on luck or wishful thinking. They approach the market with a mindset rooted in probabilities, understanding that no trade is guaranteed. There's always risk, but with the right mental framework, you can manage it and make informed, disciplined decisions. The 3 core mental shifts to think like a trader. Douglas lays out 3 core mental shifts you need to make to start thinking like a trader, and they all start with embracing uncertainty. 1. Shift from a winner-takes-all mindset to a probabilistic mindset. The first shift is to stop thinking in terms of certainty. Most new traders make the mistake of believing that a trade will either be a success or failure, and they make decisions based on that binary outcome. But here's the reality. No one knows what's going to happen next in the market. It's about probabilities, not certainties. A professional trader doesn't think in terms of winning or losing. They think in terms of probability. They understand that a particular setup has a certain chance of success, and over time, with enough trades, they'll win more than they lose if they stick to their process. 2. Shift from seeking perfection to embracing imperfection. This is a big one. As a new trader, you might be obsessed with perfection, wanting to enter and exit at the absolute best time, thinking you need to catch every move in the market. But that's not how successful traders operate. Perfection doesn't exist in trading, and striving for it will only lead to frustration. Professionals understand that the market is imperfect, and they're okay with that. They make trades based on their system, with flaws and all, and they know that imperfection is part of the process. The key is to stay consistent and manage the risk, not chase perfection. 3. Shift from emotional trading to disciplinary trading. Emotions are your biggest enemy in trading. If you're letting fear, greed, or frustration dictate your decisions, then you're going to end up in a constant cycle of poor trades. Successful traders learn to control their emotions and let their trading plan guide them. A professional trader follows a set of rules and trusts the process. They have a clear understanding of their risk tolerance, and they don't let emotions cloud their judgment. If they make a loss, they accept it, learn from it, and move on. They don't let it turn into revenge trading or act out of fear of missing out. The role of consistency in thinking like a trader. Now, let's talk about consistency, another pillar of a professional trader's mindset. When you start thinking like a trader, you stop focusing on the short-term fluctuations and start thinking about long-term consistency. The professional mindset understands that trading is all about the long game. Short-term results don't matter as much as you might think. A trader's job is to stick to their plan, execute consistently, and let the profits compound over time. They don't get discouraged by a losing streak because they understand that consistency is the path to long-term success. The power of adaptability. Another thing professionals know how to do is adapt. The market isn't static, it's constantly changing. A trader who sticks to the same plan without adapting to market conditions is bound to fail. To think like a trader, you have to embrace the idea of constantly evolving and adjusting your strategies when necessary. Whether it's tweaking your risk management rules or learning from your mistakes, adaptability is key. Embracing risk and managing it. One of the most difficult concepts for traders to grasp is risk management. As a professional, you know you'll have losing trades, and that's part of the game. What makes you successful isn't avoiding losses, it's how you manage risk and limit your losses. A trader doesn't bet the farm on one trade. They use proper position sizing and manage risk with every trade. By thinking in probabilities and embracing risk, you're able to make more rational decisions and avoid the emotional swings that most retail traders experience. This mental shift will allow you to stay in the game long enough to become consistently profitable. The takeaway: shift your mindset, shift your results. To sum it up, if you want to think like a professional trader, you need to make these crucial mental shifts. 1. Think in probabilities, not certainties. 2. Embrace imperfection, not perfection. 3. Follow your plan with discipline and consistency. 4. Adapt and evolve your strategies. Embrace risk and manage it effectively. Once you begin to internalize these shifts and develop the right mindset, trading becomes less about luck and more about skill. So, what mental shift are you going to make today? Are you ready to stop chasing perfection and start thinking in probabilities? Let's do this. Your journey to become a professional trader starts with the mindset shift. The nature of mental discipline. We're diving deep into one of the most crucial aspects of becoming a successful trader: mental discipline. Now, discipline is a word we often hear, but how does it actually apply to trading? How do you develop the kind of mental discipline that will help you stay calm, stick to your plan, and make consistent profits? That's what we're going to break down today. What is mental discipline? First off, let's talk about what mental discipline really means in the context of trading. It's about having the self-control to follow your strategy without giving in to emotions. It's about knowing the rules of your system and sticking to them, no matter how tempting it might be to break them. Imagine this. The market moves fast, emotions run high, and there's pressure to make quick decisions. Mental discipline is what keeps you from panicking or chasing the market. It's the ability to stay focused on your plan, not get swept away by the noise, and make rational decisions based on logic, not emotion. Sounds tough, right? Well, that's exactly why it's a key to success. Discipline is the key to consistency. Douglas highlights how discipline is the key to consistency, something that every trader dreams of. It doesn't matter if you're a beginner or a seasoned pro. If you can't maintain your mental discipline, your results will be all over the place. Without discipline, your trading will be a roller coaster. Sometimes you win, sometimes you lose, and there's no consistency. You might feel great after a big win, but then make impulsive decisions based on emotions after a loss. On the flip side, mental discipline helps you stay consistent with your process. You'll follow your strategy even when it's hard, even when you're tempted to abandon it after a loss. Consistency in your approach will result in long-term profitability. Discipline is the bridge between your goals and your results. The role of patience and self-control. Mental discipline isn't just about controlling your actions. It's also about controlling your thoughts. The market can be unpredictable, and you'll often face the temptation to make impulsive decisions based on fear or greed. Patience and self-control are your best friends here. You have to train yourself to wait for high-probability setups rather than jumping into every trade that comes along. It's about knowing that the next trade might not be the best one, and that's okay. Professionals know that the market will always be there. There's no need to rush into things. Self-control is also key when things go wrong. If you take a loss, and you will, your emotions might want to make you chase the market and try to get your money back. But true discipline means cutting your losses and sticking to your plan, knowing that you'll get another opportunity. Patience and self-control are what separate the amateurs from the professionals. Building mental discipline. It's a habit. Just like any other skill, mental discipline is something you develop over time. It's a habit, and like any habit, it requires practice. One of the first steps is to recognize when you're being emotionally reactive, when you're letting fear, greed, or excitement drive your actions. Start by setting clear rules for your trading. These rules could include how much you're willing to risk, when to enter a trade, and when to exit. The more specific and clear your rules are, the easier it will be to follow them. When you have clear rules, you give yourself fewer chances to second guess or make emotional decisions. Then, commit to your rules no matter what. It's okay to make mistakes, but it's important to learn from them. The more you stick to your rules, the more confident you'll become in your discipline. Over time, you'll build up a mental strength that will help you stay calm and focused even in the face of high-stress situations. The role of focus in mental discipline. Focus is a critical component of mental discipline. The more focused you are on your trading plan, the less likely you are to be distracted by emotions or external noise. Focus means staying present in each trade, paying attention to market conditions, and not letting your mind wander off to your next trade or a possible profit. One of the best ways to improve your focus is by limiting distractions. Whether that means turning off social media, minimizing the number of charts you watch, or setting specific trading hours, reducing distractions will help you stay in the zone when you need to be. Mental discipline and risk management. We've talked about risk management before, but mental discipline plays a huge role in it. A lot of traders know that they should use stop losses and not risk too much on each trade, but when emotions take over, all that goes out the window. With mental discipline, you follow your risk management rules no matter how strong the temptation is to break them. If you hit your stop loss, you accept the loss and move on. If you've already hit your daily limit for risk, you walk away, even if you feel like you're missing out on a big opportunity. Mental discipline keeps you from overtrading, taking unnecessary risks, or letting a loss turn into a bigger loss. The takeaway: discipline equals freedom. So, let's wrap this up. Mental discipline is the foundation of successful trading. It's about sticking to your plan, managing your emotions, and making rational decisions even when the market is unpredictable. It's about patience, focus, and self-control. If you can develop the kind of discipline that Mark Douglas talks about in this chapter, you'll be able to handle whatever the market throws at you. Discipline is freedom. The freedom to make decisions based on your plan, not your emotions, and to take control of your trading career in the long run. The process of building trust in a trading system. First things first, trusting your system is the foundation of consistent profitability. Without trust, you'll constantly be second-guessing your trades, making impulsive decisions, and ruining your results. The problem is, trust doesn't come naturally. It's something you have to earn, and you do that by proving to yourself that your system works. But how do you build that trust? Douglas says that the journey to trusting your system starts with backtesting and paper trading. These are essential steps because they help you get familiar with how your strategy performs in various market conditions. Backtesting is like a rehearsal. It shows you how your system would have performed in the past, and paper trading allows you to practice without real money on the line. Doing this repeatedly helps you build confidence in your system's potential, making it easier to trust it when you trade with real money. But here's the catch. Backtesting and paper trading alone won't be enough. Trust isn't built overnight, and even though the system may have performed well historically, you still need to prove to yourself that it works in real time. Consistency is key. You can't just use your system for a few trades and expect to automatically trust it. Trust takes time, and it's built through consistent application. Every trade you make is an opportunity to test your system and see if it holds up under real market conditions. And yes, there will be losing trades, but that's part of the deal. The key is to stay consistent with your system, no matter what. Consistency breeds confidence. And the more you stick to your system, the more you'll see the results over time. Even if your system doesn't give you the results you expect on a single trade, the long-term consistency will pay off. Trusting your system means you believe in the process, not just the outcome of each individual trade. The power of following the plan. Another major point that Douglas emphasizes is the need to follow your plan to the letter. It's easy to get distracted or become emotionally attached to the market. But the truth is, discipline is what differentiates successful traders from the rest. The market will throw a ton of volatility your way. But if you're not following a clear plan, you're going to fall into the trap of making impulsive decisions. A good trading system has set rules, whether it's about entry, exit, or risk management. And trusting your system means you follow those rules every single time. It's about following your process, not chasing after the perfect trade or trying to predict the next big market move. The role of emotion in trusting your system. One of the biggest challenges that traders face is managing their emotions. Even if your system is proven to work, when the market starts moving quickly, emotions can cloud your judgment. You might feel anxious during a drawdown, or fear can make you exit too early. Trusting your system means acknowledging that these emotions are normal, but learning not to act on them. Douglas points out that emotions are a trader's worst enemy. When you act on emotions, you undermine your ability to follow your plan. Trusting your system means not giving in to the fear of losing and not letting greed push you to overtrade or risk more than you should. When you trust your system, you can accept both wins and losses with the same level of detachment, knowing that the next trade is part of a larger series. Your system is designed to work over the long term, not to guarantee short-term profits. And by consistently following it, you'll find that your emotional reactions lessen, making it easier to stay calm and collected, tracking results and adjusting your system. Another point to keep in mind is that trusting your system doesn't mean blindly following it without ever looking at the results. If you're not tracking your performance, then you're flying blind. Keeping a detailed trading journal is essential. It allows you to see how well your system is performing over time. Now, if you notice that your system isn't working as expected, it's important to adjust and refine it. But you should only do this based on real data, not just based on one or two bad trades. Trusting your system means making small, calculated tweaks when necessary, and always making sure those changes are backed by solid evidence. The long-term perspective. Trust in the process. Douglas concludes this chapter by stressing that trusting your system is ultimately about having a long-term perspective. Markets are dynamic and unpredictable, but if you have a system that has been thoroughly tested and proven to work over time, your job is simply to follow it faithfully. You don't need to predict the market. You just need to stick to your system and trust the process. Patience is key here. You'll have both winning and losing trades, but in the long run, your system will work if you stay consistent. Trust in the process, trust in the numbers, and trust yourself. The takeaway: stick to your plan and trust the process. So, what can you take away from this? To truly succeed in trading, you must trust your system. Start with backtesting and paper trading, stick to your plan, and don't let emotions derail your process. Consistency is your ally, and by following your plan, you'll gradually build trust in your system and yourself as a trader. Remember, trading isn't about finding the perfect trade. It's about following a system you trust and allowing the long-term results to speak for themselves. Trust your system, stick to your plan, and let the profits come in time. The dynamic self-discipline. This chapter is all about self-discipline, which is absolutely crucial for successful trading. Let's break down how you can develop the kind of self-discipline that'll keep you from falling into the emotional roller coaster of trading and help you stay focused, consistent, and profitable. Why self-discipline is the key to success. If there's one thing every trader needs, it's self-discipline. Why? Because without it, you'll find yourself acting on emotions rather than sticking to a strategy. We all know that emotions like fear, greed, and excitement are powerful forces. And when you let them take over, your trading decisions become irrational and impulsive, leading to poor outcomes. Self-discipline is what keeps you on track, even when the market is moving fast or when you're feeling anxious. It's about controlling yourself, sticking to your plan, and not letting emotions dictate your actions. In other words, self-discipline means being your own boss, setting the rules and following them, no matter what. Overcoming emotional trading. Let's talk about one of the biggest challenges traders face: emotional trading. Emotional trading happens when you make decisions based on how you're feeling in the moment, whether you're feeling scared, greedy, or overly confident. The problem is, emotions cloud judgment and lead to mistakes. So how do we fix this? Douglas explains that the first step in overcoming emotional trading is becoming aware of your feelings. You need to recognize when you're feeling anxious or excited and understand how those emotions affect your decisions. The moment you catch yourself feeling emotional, you can take a step back, breathe, and refocus. The goal here isn't to completely eliminate emotions, because that's impossible. Instead, it's about managing them. Once you can acknowledge your emotions, you'll have the power to choose your next actions based on logic, not emotion. Developing self-discipline, strategies and tips. Now, let's get into the strategies you can use to develop the self-discipline you need to succeed in trading. 1. Set clear rules and stick to them. First things first, set clear rules for yourself. These rules could include how much you're willing to risk, when you'll enter a trade, when you'll exit, and how you'll manage your emotions. The more specific and detailed your rules, the less room there is for impulsive decisions. When you have rules in place, you can follow them automatically without getting distracted by your emotions. 2. Use a trading journal. Douglas emphasizes the importance of tracking your trades and reflecting on them. A trading journal is your best tool for building self-discipline. Write down why you entered a trade, how you were feeling, what happened, and whether you stuck to your plan. This reflection helps you identify emotional triggers and areas where you need to improve. A journal isn't just for tracking wins and losses, it's for understanding the emotional state behind each trade. Over time, you'll start to see patterns in your emotional reactions, and you can learn how to handle them better. 3. Set small, achievable goals. One of the best ways to build self-discipline is to set small, achievable goals. Instead of focusing on making huge profits right away, focus on mastering the basics. Maybe your first goal is to stick to your risk management rules for a week. The next goal might be to enter trades only when your setup criteria are met. Gradually build on these goals as you develop your discipline. Small wins lead to bigger wins. Every time you achieve a goal, you'll feel more confident and empowered to tackle the next one. Eventually, this will build the kind of discipline that turns you into a consistent, rational trader. 4. Take breaks and stay focused. Another tip for developing self-discipline is to take breaks. Trading can be mentally exhausting, and when you're tired, your discipline goes out the window. Schedule regular breaks to step away from the screens, clear your head, and refocus. A fresh mind is key to making rational decisions and sticking to your plan. It's also important to limit distractions. Whether it's social media, news, or chat groups, you need to stay focused on your trading. If you're constantly checking the news or looking at random stock tips, it's easy to lose your discipline and make poor decisions. 5. Build patience. Patience is another huge part of self-discipline. You can't rush the market, and you can't rush your trading journey. Patience means waiting for the right setups, not overtrading, and not jumping in because you're feeling impatient. You have to trust that the market will provide opportunities, and your job is to stay disciplined and wait for them. 6. Accept losses and move on. One of the hardest things to do in trading is accepting losses, but losses are a part of the game, and how you handle them will determine your success. Self-discipline means not letting losses affect your next trade. Instead of dwelling on the loss, accept it, learn from it, and move on. The key is to stay detached from the outcome and focus on the process, following your rules and making consistent, rational decisions. The role of self-discipline in consistent profits. The real power of self-discipline is in how it affects your consistency. Without it, you'll be all over the place. Some's winning big, but more often losing because your emotions got the best of you. But with self-discipline, you can maintain consistent, logical decisions and consistent profits. Over time, you'll see that consistency is the real goal. It's not about getting rich off one trade. It's about sticking to your strategy, following your rules, and allowing the market to reward you over the long term. Self-discipline is what keeps you on track to reach your trading goals. The takeaway: master your emotions and master your trading. So, what's the bottom line? If you want to be a successful trader, you need to develop self-discipline. It's about managing your emotions, sticking to your rules, and consistently applying your strategy. Building self-discipline isn't easy, but with small steps, tracking your progress, and always reflecting on your trades, you'll develop the mental strength needed to stay calm, focused, and rational. Remember, self-discipline is the cornerstone of long-term success. The zone, a state of mind. In Chapter 12 of Trading in the Zone, we're diving into one of the most powerful concepts in trading, the zone. This is the state of mind that all top traders aim for, where they're calm, focused, and in perfect sync with the market. It's like a superpower, and in this chapter, we're going to learn how to get there and stay there. So what exactly is the zone? What is the zone? The zone is that mental state where you're so immersed in the market that you're not consciously thinking about what to do next. You're just flowing with the price action, responding naturally, and making decisions without hesitation. It's almost like you've become one with the market. You're not just observing it, you're part of it. When you're in the zone, you're fully focused, but you're also calm and detached from the emotional ups and downs of the market. It's a place where your mind is working at its absolute best, and everything clicks. The best part? You don't even need to force yourself to get there. It happens when you're in the right mindset. Why is the zone so important? If you've ever experienced it, you know that being in the zone is like unlocking a whole new level of trading. Why? Because in that state, you're free from fear and greed, and you're completely in control. Your intuition and your strategy are in perfect harmony, and your mindset is exactly where it needs to be. The reason the zone is so powerful is because it allows you to act quickly without second-guessing yourself. Your decisions aren't clouded by doubt or emotional reactions. You're simply following your strategy, trusting your analysis, and responding to the market as it moves. How to achieve the zone? Getting in the right mental space. Now, let's talk about how to get there. Achieving the zone isn't something that happens automatically for most people. It takes work and practice. But once you understand how to achieve it, you can make it a regular part of your trading routine. 1. Clear your mind. The first step to getting into the zone is to clear your mind. This means letting go of past losses or frustrations from earlier in the day and not letting your mind wander into thoughts of what could happen in the future. Focus on the present moment. Just you, your strategy, and the market. Meditation and breathing exercises can help get you into a calm and focused state. The more you can center yourself and stay grounded, the easier it will be to enter the zone. 2. Focus on the process, not the outcome. To get into the zone, you have to shift your focus. Instead of obsessing over the results of your trades, how much money you're making or losing, focus on the process. The market will do what it does, and your job is to follow your plan and make the best decisions according to your strategy. When you're attached to the outcome, whether it's a win or a loss, you start to feel anxious, and that can pull you out of the zone. But when you focus purely on executing your plan and following your rules, you're much more likely to enter the zone and stay there. Hack 3. Detach from emotions. Emotions are the number one thing that will pull you out of the zone. Whether it's the excitement of a big win or the fear of a loss, emotions cloud your judgment and interfere with your trading decisions. To enter the zone, you need to be detached from those emotions. This doesn't mean you have to become a robot. It's about not allowing your feelings to drive your decisions. In the zone, your emotions are just background noise. You're focused on what the market is doing and what your strategy tells you to do next. That's it. Nothing else matters. 4. Trust your intuition. Once you've cleared your mind and detached from emotions, it's time to trust your intuition. In the zone, you're not overthinking or second-guessing yourself. You're responding to the market instinctively, without needing to consciously process every move. This is why experience is so important. The more you trade and the more you observe price action, the more you'll develop a gut feeling about where the market is going. You'll start to sense the flow of the market, and your intuition will guide you to make the right decision at the right time. 5. Stay present. Being in the zone is all about being fully present in the moment. This means focusing entirely on the current trade, the current setup, and what's happening in the market right now. Don't get distracted by thoughts of the past or the future. Just stay in the moment. This presence is key to staying focused and not making impulsive decisions based on fear or excitement. When you're present, you're reacting to the market as it unfolds. instead of trying to force things to happen or looking for shortcuts. What to do when you're out of the zone. It's important to recognize that you won't always be in the zone. There will be times when you're off, when you're feeling distracted or emotional, and when your trading decisions just don't make sense. When this happens, don't beat yourself up. Just take a break and reset. Sometimes the best thing you can do is step away from the screen, breathe, and get back to a neutral state. When you're ready, you can return to the market with a fresh mind and the right mindset to get back into the zone. The takeaway: the zone is the ultimate mental state for trading. So, what's the bottom line here? The zone is the ultimate mental state for traders. It's the place where you're at your most focused, calm, and in tune with the market. To get there, you need to clear your mind, focus on the process, detach from emotions, trust your intuition, and stay present. Remember, achieving the zone isn't something that happens overnight. It takes practice and experience, but the more you work on your mental state, the more often you'll find yourself in this powerful zone, making clear, confident, and intuitive decisions that lead to consistent success in the market. The Trader's Edge, the mental dynamics of consistency. In this chapter, we're tackling one of the most crucial aspects of successful trading: consistency. It's not about winning big on a few trades or hitting home runs every time. It's about consistently making the right decisions and executing your strategy over time. This is what separates the pros from the rest. So, let's break it down and understand how you can develop the mental strength to be consistently successful in the markets. What does consistency really mean? When we talk about consistency in trading, we're not just talking about sticking to a strategy. It goes much deeper than that. Consistency is about the mental and emotional control you bring to every trade. It's about being able to follow through on your trading plan, day in and day out, without letting emotions like fear, greed, or excitement drive your decisions. A consistent trader is someone who can perform at their best even when things are uncertain, and who doesn't get thrown off course by the inevitable ups and downs of the market. It's about maintaining a steady mindset, regardless of external conditions. The challenge of consistency. Let's be real. Trading is hard. There's a lot of volatility. There's always uncertainty, and you're constantly being faced with tough decisions. On top of that, there's human nature. Your emotions, your biases, and your natural reactions to winning or losing that can easily throw you off. But here's the thing. Consistency isn't about avoiding mistakes or being perfect. It's about staying grounded and sticking to the process, even when things go wrong. It's about keeping your head straight and not allowing a few bad trades to affect your performance, and not letting a few good trades go to your head either. Why consistency matters? Consistency is the foundation of successful trading. Without it, even the most talented traders will struggle. Think about it. Trading is a marathon, not a sprint. You can't expect to win every single trade, and that's okay. What's important is that over time, your approach leads to positive results. Consistency builds confidence. When you stick to your plan, execute trades the right way, and manage your risks well, you'll start to see improvement in your trading performance. This builds trust in yourself and your system, which is essential for long-term success. How to develop consistency in trading. Now that we know why consistency is important, let's break down how you can actually build it into your trading routine. It doesn't happen overnight, but with the right mindset, you can start becoming more consistent with each trade. 1. Stick to your trading plan. The first step to consistency is having a solid trading plan and sticking to it. It doesn't matter how you feel about the market or how tempting it is to jump into a trade that doesn't fit your criteria. Stick to your rules. If you've created a system for yourself that has a proven track record, trust it. Your plan should cover everything from entry and exit points to risk management and trade size. The more you follow your plan without deviation, the more consistently you'll perform. Manage your emotions. This is where most traders slip up. They let their emotions get the better of them, whether it's fear after a losing trade or greed after a winning streak. Emotions can mess with your consistency because they cloud your judgment. To stay consistent, you need to control your emotional responses. One strategy is to take a break when you feel your emotions getting the best of you. If you're feeling stressed or anxious, step away for a moment and return when you're more level-headed. When you're in control of your emotions, it's easier to make rational, consistent decisions. 3. Focus on the process, not the results. When traders focus too much on the outcome, how much money they're making or losing, they start to make decisions based on short-term results. But trading is about the long-term process. If you focus on executing your strategy and following your rules, the results will follow. It might take time, but if you're consistent with your process, the profits will eventually come. Don't get distracted by short-term gains or losses. Stay focused on the big picture and remember that consistency is built over time, not in a few lucky trades. Hack 4. Learn from every trade. Even the most experienced traders have losing trades. It's part of the game. The key is learning from every single trade, whether it's a win or a loss. Take time to reflect on each trade. Ask yourself why it worked or why it didn't, and make adjustments to improve your strategy. Consistency isn't about being perfect. It's about improving little by little every day. With each trade, you're getting better and building towards greater consistency. 5. Trust the process. Trusting the process is crucial. There will be times when your strategy doesn't seem to be working, or when you're tempted to abandon your plan in favor of a quick fix. But true consistency comes from trusting that the process works, even when the results don't show up immediately. Don't get impatient. Trust that sticking to your plan, refining your approach, and learning from your mistakes will pay off in the long run. The takeaway: consistency is key. At the end of the day, consistency is the key to becoming a successful trader. It's about executing your plan, managing your emotions, and focusing on the long-term process. No matter how many trades you make, the goal is to consistently stick to your strategy and improve with each trade. Remember, trading isn't about making big wins every day. It's about creating small, consistent victories over time. That's how you'll build the foundation for long-term success. So focus on consistency, trust your process, and keep improving with every trade. The trader's edge, the mental dynamics of risk, to one of the most important and often overlooked aspects of trading, risk management. We all know that trading comes with risk, but the real question is, how do you manage that risk without letting it mess with your mind? How do you handle the losses that inevitably come along the way? Let's explore these questions and understand how you can master the mental dynamics of risk to stay in the game for the long haul. Understanding risk. It's part of the game. First things first, let's face the reality. Risk is a part of trading. No matter how good you are, there's no way to eliminate risk completely. The markets are unpredictable, and sometimes, no matter how carefully you plan, things just don't go your way. The key here is to manage risk effectively, so that when things go wrong, you're not crushed by it. It's not about trying to eliminate risk. It's about understanding it and being prepared for it. If you go into the market without a clear strategy for managing risk, you're basically setting yourself up for failure. But if you approach risk management with the right mindset, you'll be able to take losses in stride and keep moving forward. Why do traders struggle with risk? You might think you're prepared for the risks in trading, but the reality is that human nature often gets in the way. The fear of loss is one of the most powerful emotions that traders face. Losing money can trigger emotional responses that cloud your judgment and mess with your decision-making. Fear can lead to impulsive actions, like closing out trades too early, avoiding risk altogether, or chasing after the next trade out of desperation. On the flip side, there's also greed, the emotional desire to chase after big wins. Greed can make you take on too much risk, over-leverage yourself, or hold on to a losing position longer than you should. Both fear and greed can derail your trading and prevent you from managing risk properly. The key to managing risk is to separate your emotions from your trading decisions. You have to make risk management a logical, planned part of your strategy, not something that's driven by how you feel in the moment. The importance of defining your risk. So, how do you manage risk effectively? It all starts with defining your risk. This is where a lot of traders go wrong. They enter trades without clear boundaries. How much are you willing to lose on each trade? What percentage of your capital are you willing to risk? By setting these limits before you even enter a trade, you remove the guesswork. You set a stop loss that reflects your comfort level, and you stick to it. This is where you gain control over the emotional aspect of trading. You're not allowing yourself to be swayed by the current market conditions or your emotions. You're acting based on logic and strategy. Handling losses, the key to staying mentally strong. Let's be real, no one likes losing. It feels terrible, especially after a few successful trades. But here's the truth. Losses are inevitable, and if you can't handle them properly, you're going to struggle with long-term success in trading. The real question is, how do you handle a loss mentally? First off, don't take it personally. A loss doesn't mean you're a bad trader or that you made a terrible mistake. It's simply part of the game. The markets are unpredictable, and sometimes things just don't go your way. Stay objective. When you can separate your identity from the outcome of your trades, you'll be much better equipped to bounce back from losses. The power of risk-reward ratio. One way to manage risk effectively is by focusing on the risk-reward ratio. This is a simple yet powerful concept. For every trade, you want to make sure that the potential reward far outweighs the risk. For example, if you're willing to risk $100 on a trade, you should aim for a potential profit of at least $200 or more. This way, even if you have more losses than wins, you can still come out ahead in the long run. By focusing on this ratio, you can take the emotional weight out of individual losses. One loss doesn't mean a disaster. As long as your overall strategy is sound and your risk-reward ratio is favorable, you can continue to trade confidently. Risk management is about control, not elimination. It's important to understand that risk management is not about eliminating risk altogether. That's impossible. Instead, it's about controlling the amount of risk you take on in each trade. By defining your stop-loss points, sticking to a solid risk-reward ratio, and keeping your emotions in check, you can control the risk exposure you have in each trade. In fact, it's when traders try to completely avoid risk that they often make the biggest mistakes. If you avoid risk completely, you're never going to make any meaningful profits. The goal is to manage risk intelligently so that you can keep trading without being emotionally or financially devastated by a loss. How to strengthen your mental approach to risk. To build a strong mental approach to risk, here's what you need to do. 1. Accept losses as part of the process. Losses aren't failures, they're simply part of the learning process. Every loss is an opportunity to learn and improve. 2. Use stop losses and position sizing. Always use stop losses to define your risk on each trade, and make sure your position sizing is aligned with your risk tolerance. 3. Control your emotions. Recognize when emotions are driving your decisions, and take a step back to regain control. Emotional decision-making leads to bad risk management. 4. Stay consistent. Stick to your strategy and risk management rules every time. Consistency is the key to long-term survival and success in trading. Shot the takeaway. Mental mastery of risk. When it comes to trading, risk is something you can't escape, but you can master your mental approach to it. By defining your risk, using the risk-reward ratio, handling losses with a positive mindset, and staying emotionally disciplined, you can turn risk into an opportunity to grow and succeed. At the end of the day, trading isn't about avoiding risk. It's about managing it in a way that lets you stay in the game long enough to see success. So embrace the challenge of managing risk and watch as you build not only your trading skills, but your mental resilience too. The trader's edge, the mental dynamics of reward, how to manage your expectations and stay focused on the process rather than getting consumed by the outcome. It's all about shifting your mindset from being fixated on profits to being deeply involved in the journey of trading itself. So, buckle up and let's dive into it. The trap of reward obsession. We all know the feeling, the rush of seeing profits and the desire to constantly experience that feeling. It's natural, right? After all, we're all in this game to make money. But here's the thing. When you focus too much on the reward, the profits, it can distort your approach to trading. This obsession with the end result can make you take on more risk than you should, act impulsively, or abandon your trading plan altogether. And when things don't go your way, you're left feeling frustrated, lost, and questioning everything. If you're constantly focused on the money, it clouds your judgment. It's not just about making money. It's about staying true to the process, learning, adapting, and growing with every trade you make. The money will come if you stay focused on the right things. Focusing on the process, not the outcome. In this chapter, Mark Douglas emphasizes a crucial lesson for any successful trader. Don't chase the outcome, chase the process. What does that mean? It means that instead of thinking about how much money you're going to make on each trade, you focus on executing your strategy with discipline and consistency. Every time you enter the market, it's about following your rules, sticking to your plan, and trusting the process. When you approach trading with this mindset, you begin to see the market as a series of opportunities. You don't attach emotional weight to any single trade. Whether you win or lose, you simply look at it as part of your ongoing journey to becoming a better trader. The reward comes naturally when you consistently follow your process and improve over time. Managing expectations, the reality of trading. Now, let's talk about expectations. Many traders come into the market with big dreams, huge profits, instant success, and a quick way to financial freedom. But the reality is, trading is a long-term game. The majority of traders don't hit it big on their first trade, and that's okay. Managing your expectations is key. Mark Douglas highlights that expecting immediate rewards or quick returns can cause frustration and lead to bad decision-making. The reality is, sometimes you're going to have losing streaks, and sometimes you're going to experience drawdowns. That's just part of the game. If you're constantly chasing after a reward, you're missing the point. The true reward of trading isn't in the money, it's in the skill development, the mental growth, and the discipline you gain along the way. When you manage your expectations and accept the inherent uncertainty in the market, you free yourself from the emotional ups and downs that come with the pursuit of money. The importance of patience in trading. Trading requires patience, and when you're focused on the process, you learn to wait for the right opportunities. Instead of forcing trades because you're eager for a reward, you wait for the market to align with your plan. The more patient you are, the more likely you are to make disciplined, well-thought-out decisions. Impatience is one of the greatest threats to your success because it leads to emotional trading, where decisions are made based on fear or greed rather than logic and strategy. Patience allows you to stay in the game longer, which is crucial for long-term success. The market rewards those who can wait for the right setups, stick to their plan, and not get swayed by the temptation to jump in just for the sake of it. Rewiring your brain for consistent success. As traders, we have to rewire our brains to think in terms of process, not outcome. Mark Douglas emphasizes that the key to success is in shifting your focus away from the outcome and instead concentrating on executing your plan with precision. This is a mental discipline that will not only help you in trading, but in life overall. By focusing on the process, you give yourself the freedom to learn from your losses instead of being crushed by them. You can reflect, adjust, and move forward rather than getting stuck in a cycle of emotional highs and lows. When you focus on the process, every trade becomes a learning experience, whether you win or lose. Reward will follow process, not the other way around. Mark Douglas shares that the real reward of trading doesn't just come from the profits. The reward lies in the growth you experience as a trader, the discipline you build, the mental clarity you develop, and the consistency you achieve. All these mental shifts lead to sustainable success in trading. The more you trust the process, the better you'll get at handling the mental challenges of the market. And as a result, the rewards, both financial and personal, will naturally follow. The takeaway: stay focused, stay process-driven. At the end of the day, the reward is not the goal. The goal is to focus on your process. When you adopt a process-driven mindset, you're able to manage your emotions, stay disciplined, and make decisions that align with your long-term goals. Don't get distracted by the immediate payoff. Stay committed to the work and the rewards will come over time. So, next time you're tempted to focus too much on how much money you can make from a trade, remember this: the process is the reward. Keep working on your skills, trust the journey, and know that consistent effort will lead to the financial success you desire. The trader's edge, the mental dynamics of execution. Let's talk about something that's critical for your success in the market: execution. In this chapter, we dive into the psychological challenges behind executing trades and how you can stay disciplined. A lot of traders struggle with this part, but trust me, mastering execution can be a game changer. So, let's break it down and get you into the right mental zone for trade execution. The struggle of pulling the trigger. Have you ever been in a situation where everything is set, your analysis is spot on, your strategy is ready to go, but you hesitate? You just can't bring yourself to pull the trigger on the trade. Sound familiar? That hesitation is one of the biggest psychological challenges in trading. Mark Douglas explains that this delay in execution often stems from fear. Fear of making a mistake, fear of losing money, or simply fear of being wrong. The problem is, this fear can paralyze you and keep you from taking action when it's time. The key is to acknowledge that fear, but not let it control your decisions. It's all about making peace with uncertainty and realizing that losses are part of the game. Why discipline is key. When you're trading, discipline isn't just about sticking to your plan. It's about trusting your strategy and executing it without second guessing. The market doesn't care about your emotions or your fears. It's moving on its own, and if you don't act quickly, you'll miss out on opportunities. So, the key is to develop a mindset that allows you to act decisively and without hesitation. How do you do that? First, it's about preparing yourself mentally before each trade. Know exactly what you're going to do when certain conditions are met. It's not about reacting in the moment. It's about being prepared and executing your plan without emotion. Mark Douglas calls this creating a mental checklist. When the market conditions meet your criteria, you pull the trigger. No second guessing, no hesitation. Overcoming self-doubt. Self-doubt is another major factor that hinders execution. Even if you've done all your research and analysis, you might still question whether it's the right time to trade. That's where confidence comes in. Confidence in your strategy and in your ability to execute it without letting doubt creep in. But how do you build that confidence? It's not about being 100% sure every time. No trader is ever 100% sure. It's about trusting the process and knowing that even if you make a mistake, it's just part of learning and improving. Building self-trust comes from consistently executing your plan and learning from each trade. The more you do it, the more confidence you gain in your ability to make good decisions. The urge to change your plan. One of the toughest psychological challenges is when you're in the middle of a trade and you start thinking, maybe I should adjust my stop loss. Maybe I should get out now. Sound familiar? This is a sign of lack of discipline and emotional trading. What happens when you keep changing your plan in the middle of a trade is that you end up chasing the market instead of executing a strategy with confidence. This disrupts your entire approach and leads to inconsistency. Mark Douglas emphasizes that when you enter a trade, you need to stick to your plan. If your plan says to exit at a certain level, you stay disciplined and exit at that level. The market will test your resolve, but sticking to your plan is how you maintain consistency. The role of emotional control. Another key aspect of execution is emotional control. You see, emotions like fear and greed can cloud your judgment and influence your ability to execute properly. Let's say the market moves in your favor, and you're tempted to let your profits run because you're feeling greedy. On the flip side, if the market moves against you, fear can cause you to exit too early or adjust your stop loss. These emotional responses can sabotage your execution. How do you deal with this? You need to develop mental resilience. Remind yourself that your emotions are part of the process, but they shouldn't dictate your actions. The goal is to train your mind to stay calm, cool, and collected, no matter what the market is doing. This way, you can execute your trades according to your plan, without being influenced by fear or greed. The power of routine and preparation. One of the ways to eliminate hesitation and improve execution is by creating a routine. This routine allows you to mentally prepare for each trade, ensuring that you're entering the market with a clear mind and a solid plan. When you have a structured approach, you take away the mental clutter that causes hesitation. It's like an athlete preparing for a big game. They have a pre-game routine to get into the zone, and you should do the same before each trade. Whether it's reviewing your setup, visualizing your strategy, or simply calming your mind, having a pre-trade ritual will help you execute your trades with more confidence and discipline. The takeaway: master execution to master trading. To sum it all up, execution is the key to consistent success in trading. You need to develop the discipline to stick to your plan, the confidence to trust your analysis, and the emotional control to stay calm under pressure. The market will always throw challenges your way, but it's how you react, how you execute in the face of uncertainty, that will determine your success. So, next time you're facing a trade, remember, don't hesitate, trust your process, and execute with confidence. You've got the mental edge. Now it's time to use it. Keep mastering your execution, and the profits will follow. The trader's edge. The mental dynamics of letting go. Let's dive into one of the most powerful concepts in trading, the ability to let go. I'm not talking about giving up. I'm talking about letting go of fear, greed, and attachment to outcomes. This is a major mental shift that can take your trading to the next level. So, if you've ever felt held back by emotions or struggled with being attached to the results of your trades, this chapter is going to be a game changer for you. Let's break it down. The trap of fear and greed. Fear and greed. These two emotions are like the enemies of every trader. Fear makes you hesitate, doubt your decisions, and avoid taking trades when you should. It's that voice in your head that says, "What if I lose?" On the flip side, greed pushes you to chase after bigger profits, taking risks that you shouldn't be taking. Both emotions sabotage your decision-making and cloud your judgment. So, what's the solution? Letting go. Mark Douglas explains that in order to trade successfully, you need to release the grip these emotions have on you. The moment you stop making decisions out of fear and greed is the moment you start trading like a professional. The truth is, the market is unpredictable and you cannot control outcomes, but you can control how you respond to them. So learn to let go of the fear of losing and the desire for more profits. This is where your true power lies. The paradox of attachment. Now let's talk about attachment. It's human nature to get attached to the results. After all, we all want to win, right? But the problem with attachment is that it binds you to outcomes. When you get too attached to the results of a trade, you start to chase outcomes, which means you're not focused on the process anymore. And when you focus on the process, you're able to execute your trades without emotional interference. Mark Douglas highlights that this attachment to results makes it harder to make objective decisions. If you're overly focused on winning or losing, you might let emotions drive your trading decisions instead of sticking to your plan. The key to letting go is to stop looking at pot results as the measure of success. Instead, focus on executing your strategy well, regardless of whether the trade ends up profitable or not. Detach yourself from the outcome and trust the process. The mindset shift. Detach from outcomes. Let's get into the mental shift that you need to make. How do you let go of attachment? The first step is to accept the uncertainty of the market. The market doesn't owe you anything. No matter how much analysis you do, there's always that element of risk and unpredictability. Once you accept this reality, you'll be able to release the need to control the outcome of each trade. Mark Douglas calls this the shift from wanting to be right to accepting the uncertainty of the market. It's about letting go of the attachment to being right on every trade and accepting that losing is a part of the game. In fact, when you stop trying to control the outcome, you'll find that the stress of trading reduces significantly. You'll start to enjoy the process more because you're not tied to winning or losing. You're just focused on executing your plan and improving your skills. Building mental freedom. Now, here's the secret. When you let go, you actually free your mind to make better decisions. When fear and greed aren't controlling your thoughts, you can think more clearly, focus better, and react more objectively to the market. Mental freedom is a huge advantage in trading because it allows you to remain calm and collected even when the market is chaotic. It's like when you let go of a heavy weight. Suddenly, you feel lighter, freer, and able to move more effectively. In trading, letting go of your attachment to outcomes allows you to be more flexible, more open to different possibilities, and more resilient in the face of losses. You stop fearing the unknown, and instead, you embrace the process of becoming better with each trade. The power of trusting the process. The final piece of the puzzle is trusting the process. This is where your mental edge comes in. When you let go of fear, greed, and attachment, you can truly trust that your trading strategy will work in the long run. You stop obsessing over every single trade and instead focus on the big picture. Every trade is just a part of the journey. Some will be wins, some will be losses. But overall, you know that you're getting better and your strategy is solid. Trusting the process doesn't mean you stop evaluating and improving your strategy. It just means that you don't let the outcomes of individual trades define your success. You're focused on learning and improving, not on winning or losing each trade. This shift in mindset is what helps you stay consistent and avoid emotional roller coasters. The takeaway: let go and let the market flow. To wrap it up, the mental dynamics of letting go are all about releasing fear, greed, and attachment to outcomes. When you do that, you open yourself up to clearer decision-making, better discipline, and ultimately, greater trading success. Letting go doesn't mean you stop caring about your trades. It means you care about the process and trust that the results will follow. So the next time you're trading, remember, let go of fear, release the need for control, and detach from the outcome. By doing this, you'll find yourself trading with a clear mind, a steady hand, and a lot more mental freedom. That's the true edge every successful trader has. Keep trusting the process and watch how your trading mindset transforms. The Trader's Edge, the mental dynamics of confidence. Welcome to one of the most crucial chapters in mastering the mental game of trading: confidence. If you've ever struggled with self-doubt, second-guessing your decisions, or questioning your abilities, then this chapter is for you. Confidence is not just about believing in yourself. It's about understanding your mind, controlling your emotions, and trusting the process. So, let's break it down and unlock how to build unshakable confidence in your trading. Confidence versus arrogance, the subtle difference. First, let's clear up one thing. Confidence doesn't mean arrogance. There's a huge difference. Confidence comes from knowing that you've done the work, you have a plan, and you've honed your skills. It's being self-assured while staying grounded. On the other hand, arrogance is when you overestimate your abilities and ignore the risks involved. Mark Douglas makes it clear that true confidence comes from a deep understanding of yourself and the market. When you're confident, you know you'll face ups and downs, but you trust in your ability to handle the challenge. Arrogance, on the other hand, blinds you to the reality that markets are unpredictable and not every trade will go your way. So, confidence is rooted in realistic expectations and self-awareness, not in thinking you know it all. Building confidence through consistency. Now let's talk about how to build confidence in trading. The key is consistency. You build confidence the same way you build muscle, through regular effort. Every time you stick to your strategy, execute your plan, and manage risk, you're strengthening your trading confidence. It's not about making one big win that boosts your confidence. It's about trusting yourself to follow through, even when things don't go as planned. Mark Douglas emphasizes that success isn't just about making money. It's about sticking to your system and staying disciplined. Confidence isn't about being right every time. It's about trusting the process and knowing that, over time, the results will reflect your consistency. The role of self-talk in confidence. One of the most powerful tools you can use to build confidence is your self-talk. Have you ever caught yourself thinking, "I can't do this. This is too hard," or "I'm not good enough"? Well, those negative thoughts are the opposite of confidence. You need to reprogram your mind by shifting your self-talk to one that is supportive and constructive. Mark Douglas stresses that positive self-talk is a game changer. Remind yourself that you have a plan and you know how to execute it. Instead of focusing on past mistakes, focus on what you can control: your actions, your mindset, and your discipline. Speak to yourself like a coach would to an athlete, encouraging, realistic, and focused on growth. Embrace failures as part of the process. Here's the truth: failure is inevitable in trading. But what if I told you that failure is actually the foundation of confidence? It's not about avoiding mistakes, but about how you handle them. Every time you lose, you're gaining valuable experience that sharpens your skills and prepares you for the next trade. The key to confidence is learning to embrace failure as part of your journey, not as a setback. Mark Douglas explains that when you accept that losses are a part of the game, you'll start to detach emotionally from them. You won't let a loss shake your confidence because you understand that failure doesn't define you. It's how you respond to it that matters. With each loss, your mental resilience and confidence will grow stronger. Trusting your trading system. Another huge part of building confidence is trusting your trading system. When you have a clear strategy, a well-defined plan, and risk management rules in place, your confidence skyrockets. Why? Because you know exactly what to do in any given situation. You're not relying on emotions or impulses. You're following a proven system that has been carefully crafted through analysis and experience. Mark Douglas advises that you shouldn't doubt your system every time a trade goes against you. Instead, trust that the law of probabilities is on your side in the long run. Confidence comes from sticking to your system and letting the results play out over time. So, trust your plan, follow the rules, and let go of the need to force outcomes. The mental framework for confidence. Building lasting confidence is about creating a mental framework that works for you. Mark Douglas explains that the most successful traders have a mindset that focuses on the process, not the outcome. They accept that every trade will have a different outcome. Some wins, some losses, but their confidence is unshaken because they know the process works. To build your confidence, you need to nurture your mental framework. This means staying calm, sticking to your plan, and understanding that every trade, whether profitable or not, is part of the overall journey. When you shift your mindset from focusing on wins and losses to focusing on mastering the process, your confidence will grow naturally. The takeaway: confidence is a skill you build. Let's wrap it up. Confidence in trading is not an innate trait that some traders are born with. It's a skill that you can develop over time. The key is to stay consistent, trust your system, embrace failure as part of the process, and reframe your self-talk to be more positive and supportive. When you let go of fear, trust in your ability, and follow through with discipline, confidence will come. So, remember, confidence isn't about knowing the future. It's about trusting your plan, sticking to it, and knowing that your consistent effort will pay off in the long run. The trader's edge, the mental dynamics of patience. If there's one thing that every trader has to master, it's patience. It might not be as glamorous as nailing a perfect trade or hitting big profits, but trust me, patience is key. In this chapter, Mark Douglas dives into the mental dynamics of patience and why it's such a game changer in the world of trading. So, let's break it down and see how you can cultivate patience and use it to your advantage in trading. Patience versus impulsiveness. Know the difference. First things first, let's talk about the difference between patience and impulsiveness. Patience is about waiting for the right moment to act. It's about being calm, observing the market, and making decisions based on logic, not emotion. Impulsiveness, on the other hand, is driven by fear or greed. It's about jumping into trades without waiting for confirmation or a proper setup, simply because you're trying to force an outcome. Mark Douglas points out that impulsive trading is a result of poor emotional control. You might feel like you're missing out, and you rush into a trade thinking you need to act quickly to make money. But this is where patience comes in. It teaches you to trust that the market will give you opportunities when the time is right. Patience is all about waiting for the signal, not rushing into anything. Why patience is the secret weapon. Now, why is patience so important? Here's the thing. Trading is not about quick wins. It's about long-term success, and that requires waiting for the best opportunities. In a world where everyone wants instant gratification, having the patience to wait for high-probability setups gives you a huge edge. You're not jumping on every trade. You're waiting for the ones that align perfectly with your strategy. Mark Douglas emphasizes that the markets move in cycles, and you have to wait for the right conditions to take action. When you're patient, you're not just reacting to the market, you're responding with a clear mind, knowing that the market will give you the right signals if you're paying attention. That's where the real edge comes from. Patience lets you trade with discipline and a clear strategy. The psychological aspect of patience. Patience isn't just about sitting back and waiting. It's about controlling your emotions during those waiting periods. There's a psychological aspect to it. When you're not getting the results you want, it can be frustrating. You might feel like you need to take action just for the sake of doing something. But patience means not reacting emotionally to that frustration. It means staying centered and not letting FOMO, fear of missing out, or the urge to do something, push you into making decisions that are against your strategy. Mark Douglas explains that emotional impulses can make you feel like you have to be in a trade, but true traders know that the best trades are the ones that come to you naturally, with proper planning and patience. It's about staying cool, knowing that action will come when the time is right. How to cultivate patience in your trading. All right, now that we understand why patience is essential, let's talk about how to develop it. Patience doesn't just appear overnight. It's something you have to work on and practice. Here are some tips to help you develop that key mental trait. 1. Trust your plan. The first step to being patient is to trust in your trading system. If you have a solid plan in place, you won't feel the urge to jump into random trades. You'll know that the best trades will come when your setup aligns with your plan. Trust the process. 2. Stay present. Often, impatience comes from feeling like you're missing something. It's like you're constantly looking for the next opportunity. But trading isn't about constantly moving. It's about staying present and waiting for the best setup. Don't rush into anything just because you're not actively in a trade. Stay mindful and stay grounded. 3. Detach from the outcome. One of the key ideas Mark Douglas emphasizes is the importance of detaching from the outcome of each trade. If you're too focused on the results, you'll rush into trades trying to win fast. But if you focus on executing your strategy consistently, you'll build patience and allow the process to unfold naturally. 4. Set realistic expectations. Don't expect to win every trade. Patience is also about understanding that some trades will lose. Accept losses as part of the game and wait for the trades that align with your system. Set expectations for long-term success and don't let a few losses throw you off. 5. Use waiting time wisely. When you're waiting for the right setup, use that time to improve your knowledge, read market news, or analyze past trades. This keeps your mind busy and prevents it from wandering to impulsive decisions. Patience is a skill you can master. Mark Douglas reminds us that patience is not passive. It's an active skill that requires focus and discipline. It's about recognizing when to stay out of the market and when to take action. The more you practice patience, the more you'll realize that the best trades don't require rushing. They come naturally when the conditions are right. So the next time you feel that urge to do something, take a step back. Stay patient, trust your plan, and let the market come to you. Remember, patience is not about waiting for success to come to you. It's about knowing that you'll be ready when the opportunity presents itself. Final thoughts: patience pays off. At the end of the day, patience is one of the most powerful tools in a trader's toolkit. It allows you to stay calm, make rational decisions, and avoid the emotional traps that can derail your trading. By cultivating patience, you'll be setting yourself up for long-term success, rather than just chasing the next quick win. So, be patient, stay disciplined, and trust that the right opportunities will come when the time is right. The trader's edge, the mental dynamics of persistence. As a trader, persistence. It's the key to long-term success, especially when the market throws challenges your way. Mark Douglas digs deep into the mental dynamics of persistence in this chapter and why it's such an essential part of your trading journey. So let's break it down, and I'll show you how persistence can give you the edge you need to thrive in the markets. The power of persistence. Let's face it, trading is not easy. It can be full of ups and downs, and there will be times when you feel like quitting. You might experience losses, frustration, and doubt. But here's the truth. Persistence is what separates successful traders from those who give up. Mark Douglas makes it clear that it's not about avoiding failure, but rather how you handle it when it happens. The ability to bounce back from setbacks and keep moving forward is what will keep you in the game. Persistence isn't about having a flawless record. It's about staying committed to your process, even when things aren't going your way. It's about having the resilience to keep going after each loss and continuing to refine your strategy. As Douglas explains, resilience comes from the belief that your success is inevitable as long as you continue to put in the effort and stay consistent. Challenges are part of the journey. Now, let's talk about the challenges. No trader is immune to them. Whether it's a string of losses, a bad trade, or moments of doubt, trading is tough. But here's the catch. The challenges are part of the process. They're not signs that you're failing. They're opportunities to grow and learn. If you can approach these challenges with a mindset of resilience, you'll realize they're not setbacks at all. They're just part of the learning curve. Mark Douglas emphasizes that failure and setbacks in trading are inevitable, but they don't define you as a trader. What truly matters is how you respond. If you respond with persistence, by learning from your mistakes, improving your strategy, and adapting to the market, you'll eventually turn those challenges into your biggest strengths. Persistence is a mindset. At its core, persistence is all about mindset. It's about choosing not to give up, no matter how tough things get. It's about sticking to your rules and strategy, even when the market feels unpredictable or when you feel like throwing in the towel. Mark Douglas highlights that the best traders are the ones who have a mindset of never quitting. They keep working at it, refining their skills, and building on their experiences. Persistence means looking at each trade, whether it's a win or loss, as a step toward improvement. Every mistake is a learning opportunity. Instead of beating yourself up over a bad trade, you take note of what went wrong, adapt, and move forward with a renewed sense of purpose. Building resilience through repetition. One of the key strategies for building persistence is through repetition. Mark Douglas talks about how important it is to keep practicing, even when you don't see immediate results. It's through continuous practice that you start to internalize your trading system and refine your execution. The more you trade, the more you'll develop a sense of confidence in your abilities. But here's the kicker. You have to keep showing up. Trading isn't about perfection, it's about consistency. The more you face challenges head-on and continue to learn from them, the stronger your persistence will become. The role of belief in persistence. You might be wondering, how do you keep going when things feel tough? The answer is belief. Mark Douglas points out that successful traders are able to persist because they have an unshakable belief in their abilities and their system. They trust the process, knowing that if they keep at it, their persistence will eventually pay off. This belief is crucial. Without it, persistence becomes much harder to maintain. So, believe in yourself, believe in your plan, and know that you're capable of overcoming any challenge that comes your way. When you have that deep belief, persistence becomes second nature. Practical tips to cultivate persistence. Now that we know the power of persistence, let's talk about how you can actually build it in your own trading journey. 1. Set realistic expectations. Understand that losses are part of the game. They don't define you. The key is not to let them discourage you. Keep your long-term goals in mind and remind yourself that persistence over time leads to success. 2. Stick to your plan. One of the most powerful ways to stay persistent is by following your trading plan. It provides structure and consistency, helping you push through challenging moments. When you feel like veering off course, remind yourself of your rules and stick to them. 3. Break down big goals. Persistence doesn't mean trying to accomplish everything at once. Break your big goals down into smaller, manageable steps. This helps you focus on the process rather than the overwhelming end result. 4. Celebrate the small wins. Every small success you have is a step forward. Even if it's just sticking to your strategy or learning something new from a losing trade, celebrate that progress. These small wins will help fuel your persistence. 5. Keep a positive mindset. When things get tough, it's easy to slip into a negative mindset, but persistence thrives on positivity. Focus on what you've learned and how far you've come. Remind yourself that you are capable of handling any challenge. Final thoughts. Persistence is the key to long-term success. In the end, persistence is not just a trait, it's a lifestyle. It's about having the mental strength to keep going, no matter what the market throws at you. The more you practice persistence, the more it becomes ingrained in your trading DNA. So don't let setbacks define you. Let them fuel your drive to improve. The Trader's Edge, the mental dynamics of success. All right, traders, we've made it to the final chapter, and it's time to wrap things up. But don't worry, we're not just closing the book. We're about to summarize everything you've learned and give you the ultimate roadmap for long-term trading success. Mark Douglas brings it all together here. So let's dive into the mental dynamics of success and how you can achieve it. The mental dynamics of success, what it really means. Success in trading isn't just about making money. It's about mastering your mindset and having the right mental approach. Mark Douglas emphasizes that successful trading is a mental game. You need to train your mind to handle the ups and downs, stay disciplined, and follow your trading plan to the letter. At the core of success is trust. Trust in yourself, trust in your system, and trust in the process. If you don't trust your decisions and the strategy you've developed, you'll constantly be doubting yourself and second-guessing your trades. And guess what? That's a quick way to derail your success. So, building self-confidence and belief in your system is the foundation of lasting success. Key lessons for achieving success in trading. Mark Douglas doesn't leave you hanging. He breaks down the core principles you need to internalize for success. 1. Think in probabilities. It's not about being right all the time. It's about making decisions based on probabilities. No trade is guaranteed, but with a probability-based mindset, you can make consistent, profitable decisions over time. The best traders embrace uncertainty because they know that each trade is part of a bigger picture. Number 2, master your emotions. The ability to manage your emotions is crucial. Fear, greed, and excitement can cloud your judgment and cause impulsive decisions. The key to success is learning to stay calm, stay disciplined, and stick to your plan, no matter how the market moves. Emotional control is the secret sauce to long-term profitability. Number 3, develop a belief system that supports success. Your beliefs shape your actions. If you believe that trading is all about luck, or that losses are something you can't handle, your trading will reflect those beliefs. But if you develop empowering beliefs like, I can learn from every trade and I trust my strategy, your actions will align with those beliefs. And that's when success starts to happen. 4, persistence and patience. Success doesn't happen overnight. You will face setbacks, losses, and mistakes along the way. But the most successful traders are the ones who stick with it. They persist through the tough times, learn from their mistakes, and keep improving. Patience is just as important. Waiting for the right setup and not rushing into trades can make all the difference. 5, self-discipline and consistency. Building self-discipline is another pillar of success. If you're not disciplined, it's easy to fall into emotional trading, impulsive decisions, or even overtrading. Consistently following your trading rules and sticking to your strategy will help you stay on track, even when the market throws a curveball your way. The roadmap for long-term trading success. So, how do you achieve long-term success? Here's a simple roadmap based on everything we've discussed. 1. Develop a solid trading plan. Your plan should be your guide to making decisions. Define your goals, risk management rules, entry and exit strategies, and stick to them without deviation. A solid plan will help you stay focused and not get swayed by short-term market noise. 2. Manage your mindset. Focus on mastering your psychology. Stay calm, be aware of your emotions, and learn to handle both wins and losses without getting emotionally attached to the outcomes. Mindset is everything. 3. Accept losses as part of the game. Don't get discouraged by losses. They're part of the process, and every loss is a lesson. As long as you keep learning and improving, losses don't define you. They empower you to be better. 4. Stick with the process. Success comes from consistent execution. Trust your system, trust your plan, and be patient. It's the day-in, day-out execution of your trading strategy that adds up to long-term profitability. 5. Review and refine your approach. Regularly analyze your trades, review your performance, and refine your strategy. The market is always evolving, and so should you. Stay humble, keep learning, and make improvements where necessary. 6. Keep your focus on the long term. Trading isn't about quick wins or chasing instant profits. It's about building a sustainable approach over time. Keep your focus on the long-term game, and you'll eventually see the results. Conclusion: your path to success. The road to trading success is challenging, but it's also incredibly rewarding. It requires a solid plan, a disciplined mindset, and the ability to adapt and learn from your mistakes. As Mark Douglas says, successful traders understand that the mental game is just as important, if not more important, than the technical side of trading. So, now that you've got all the pieces, it's time to put them together. Stay committed, keep refining your approach, and most importantly, trust the process. Success will follow, and with the right mindset, you can achieve long-term, sustainable profits in the market. Stay persistent, stay disciplined, and most of all, stay focused on the journey. The mental dynamics of success are within your control, and now it's up to you to make them work for you. You've got this, traders. Keep pushing forward, and success will be yours. And that's a wrap for today's deep dive into Trading in the Zone by Mark Douglas. I hope you found these insights helpful and that they'll help you transform your trading mindset. If you enjoyed this video, don't forget to like, share, and subscribe to the channel. By subscribing, you'll stay updated with all our future content that will help you keep improving your trading game. Drop a comment below if you have any thoughts or questions about today's topic. I'd love to hear your feedback. Thanks for watching, and I'll see you in the next one.